Well, thank you everyone for joining us today. My name is Kirsten Loita. I'm a partner here at Osage University Partners, leading our university relations efforts. Today, I'll be moderating the discussion on LLCs versus corporations as startup structures, which OUP is co-hosting with Quarles and Brady. You will hear from attorneys, an investor, and an accountant on governance and structural concerns of LLCs, tax issues, including partnership provisions and conversion opportunities for LLCs, investor concerns on LLCs, particularly from the venture capital lens, and accounting issues on tax and structure of LLCs versus C corporations. So with that, we'll go to the next slide, and I'll have the panelists introduce themselves. Marc Ehrmann.
Good morning, everybody. I'm Marc Ehrmann. I'm a partner with Quarles and Brady. I work out of our Madison office. I'm in the business law group. My practice involves working in the startup space, representing startups, entrepreneurs, investors, and universities. And I also have a practice doing M&A and other corporate counseling. And I'm happy to present today. Jeff?
Hi, I'm Jeff Fugal with Quarles and Brady as well. I'm a partner in our Phoenix office. I'm a tax attorney, and I do a lot of tax choice of entity structuring issues with startups and also with a variety of other different business transactions. Marc?
Great.
Hi, I'm Marc Singer. I'm a managing partner and a co-founder of OUP, and I run our tech investment practice, which includes software companies, hardware companies, climate technologies, materials, and other areas. And I'm, as a member of the investment committee, get involved in all of our investments, including deal structuring.
Beth?
Hi, I'm Beth Grafstrom. I'm the VP of Finance at OUP. I've been there since 2015, and I'm a CPA with the state of New York.
Great. Thank you all so much. We're really happy that you are all here today. We're doing this webinar in part because we had some universities ask us about this. They're looking at their potentially, starting up their companies as LLCs. What were the differences? What should they be thinking about? And so this was a response to a request from some of our universities to do that. And we're looking forward to hearing actually from our universities. You can post some information if you're using LLCs often in the chat, but we encourage you to ask questions throughout the webinar using the Q&A tool that's in your Zoom. So we'll move on to the next slide, and Marc actually is going to talk a little bit about Quarles and Brady and their background.
Thanks. I mentioned Jeff and I are both with Quarles. We're a firm that's been around 130 years. We have offices around the country. You'll see on the slide 10 offices. We have multiple practice areas. One of the things I wanted to mention, which is not on the slide, is we have an industry team that's called the Research Institutions and Higher Education team, and that really revolves around, it's cross-disciplinary practice area that focuses on serving universities and others in that space with the technology transfer, licensing, and startup formation. So we're happy to present to you today. And if you have any more information, if you need more information about Quarles, you can look at our website. Happy to answer further questions.
Thanks, Marc. We'll go to the next slide. We know that not everyone knows OUP. We have a broad audience today for this particular webinar. So we are a venture fund that partners with academic institutions to invest in their startups, typically by exercising the participation rights available through their license agreements. As part of this partnership, the institutions share in our profits and receive programmatic support on tech transfer and academic startups. This is an example of that programmatic support this webinar today. OUP is now on its third fund, having raised approximately $600 million across 3 funds, and has made over 125 investments in all areas of deep sciences in which our academic institutions are inventing new technologies. And many of those companies have had successful exits, either through IPOs or merger and acquisition. And we're always happy to talk more about our model with anyone, but we need to move on to the content of our webinar. But feel free to reach out to us if you have any questions. So next slide. We do have a few administrative items before we get into the content of the webinar. The slides and a recording of this webinar will be available afterwards, both on OUP's partner portal as well as our YouTube channel. And the partner portal is an online portal for technology transfer officers and researchers at our partner institutions that is full of relevant tech transfer and startup content. And this slide shows you where you can find it. But again, it will be on our YouTube channel as well. We do encourage questions to be asked throughout the webinar. Please use the Q&A tool that I mentioned before to ask your questions. Please don't ask questions in the chat. They're really hard for us to keep track of there. We also received a bunch of questions beforehand, and we will be trying to get to those throughout the presentation today, and some of them will be answered by our presenters during their slides. So next slide, just a reminder of our agenda here. Marc Ehrmann's going to go first, and he will talk about governance and structural considerations. Then Jeff Fugal will talk about tax choice of entity. Marc will talk about investor considerations, and Beth will cover the accounting considerations. And then we'll get to a Q&A period, but we will ask some questions throughout the slides today. So with that, we'll start the presentations from each of our panelists, and Marc Ehrmann.
Thanks, Kirsten. You can go to the first slide. I just want to, I'm going to highlight some of the structural differences between LLCs and corporations. And there's some of my colleagues do, complete seminars on the differences. From a high level perspective, from a governance and structural perspective, I don't think there's a big difference. I will highlight some of the differences, but I wanted to put that background up front. I just wanted to mention briefly, using an entity structure obviously makes sense. We have had clients that have started businesses without creating an entity. And the problem with that is you don't get the limited liability protection that you have when you create an LLC or corporation. Any debt you incur, any contract you sign as an individual is your personal liability. So creating the entity makes sense. The entity does allow you then to have an equity structure so you can reward employees and consultants by providing them equity, which is helpful because sometimes that supplements their cash compensation. And then obviously separates your business from your personal assets and your personal structure. So you can go to the next slide. So I wanted to, on this first slide, highlight kind of the hierarchy of what affects the governance and structure of both LLCs and corporations. So first of all, you have state law. Every state in the country has its own corporate statute. It also has its own LLC statute. And for the most part, they're similar. But there are some nuances, and there are nuances among the states. So when you're deciding where to incorporate or where to set up your entity, you need to have you and your advisors kind of look at the state law. We find, as you probably are aware, Delaware is the most popular state to set up your entity in, and the reason for that is several decades ago, the Delaware Bar Association of Delaware founders wanted to become specialists in a certain area, and they created this well-known corporate law and a well-drafted corporate law. So historically, a lot of companies have been set up there, and it does help because investors, others, if they see you're a Delaware entity, they're familiar with the law and accept it. Delaware also has set up a chancery court, which is a court that really determines business disputes as opposed to kind of the general circuit court that you have in other states. So state law is important. The next thing you need to look at is your articles of organization. Now that's a public document, whether it's an LLC or corporation, that's filed in the state, and anybody can search it. And I'll talk about those in a minute. For corporations, then you also have bylaws, which really contain procedural elements. Typically, LLCs don't have bylaws. They put it in their operating agreement or equity holder agreement, which is the next thing you look at when you're setting up an entity. So if you go to the next slide, please. So let me talk about C corporations and some of the nuances that are a little bit different than LLCs. C corporations have the benefit of being well-defined under state and case law. The corporate statutes have been around for decades, whereas the LLC statutes are more recent, of more recent vintage. So you don't have as much case law behind the interpretation of corporations. Fund investors, private equity groups, or venture capitalists will typically only want to invest in C corporations. So if you set yourself up as an LLC, you may be converting to a C corporation down the road, and we'll talk about that. And I know Jeff is going to mention more about conversion down the road. With some liquidity events, it's easier to be a C corporation. For example, if you're doing an IPO, you're probably going to have to be a C corporation. There's really no good mechanism to do an IPO in an LLC context. And then the disadvantage of corporations, and Jeff's going to talk a lot about this, is you have the double tax on profits. So the corporation gets taxed, and then there's a tax when you distribute the money out to the equity holders. If you go to the next slide, please. Now, contrast with LLCs. LLCs, that less defined, they are favored by certain investors like angels and founders. And the reason for that is they like the flow through tax treatment, meaning the one level of tax. So unlike corporations, if you're taxed as a partnership as an LLC, you only have one level of tax to pay. And you have a little more flexibility because some of the governance structure that I'll mention in a minute is contained in the operating agreement versus the articles of organization, and a little easier to change down the road. So if you go to the next slide, please. So now I'm going to shift to kind of the governance structure of C corporations, then I'll turn to LLCs. In a C corporation, when you file your articles of organization, you typically have to include a number of items: your name, purpose, registered agent and office. And you need to select a registered agent and office because you need to have a place where people can find you and sue you or give you official notices. And then you have some general clauses regarding indemnification and other items. But one of the things you have in the articles for a C corporation, which you don't have for LLCs, is lengthy provisions regarding the capitalization structure. So in a C corporation, you have authorized stock, you have typically different classes and series of stock. So you'll see companies that have had multiple rounds of financing where they might have common shares and then several series of preferred shares. And then the articles go into talking about what the relative rights are among those different categories of shares. And that has to do with voting, dividends, liquidation preference. I like to think of the structure kind of as a LIFO type of arrangement where the last money in typically is the first money coming out on liquidation. So you'll see in the articles of incorporation of a company that's been received multiple rounds of financing, that might be 30 pages. And again, this is all public because it's filed with the state where it's set up. You go to the next slide, please. The next item I wanted to mention is bylaws. So you don't really usually have bylaws for an LLC. Bylaws are what I would characterize as procedural items that govern things like board composition, election, officer duties, how you can hold meetings, what type of notice you need to give, and it also has additional qualifications on indemnification and officers. Those bylaw type provisions do apply in LLCs, but they're typically found in the operating agreement, which I'll touch on in a second. And then the next slide, please. I want to mention the equity holder agreements because when we're asked to work with a startup, that's kind of the main document we start with. And the reason those are important is because you need to have an understanding and agreement among the founders as to what happens with the stock. And so we typically put restrictions on transfer. You don't want to have people outside the group become partners. And so we would put rights of first refusal first to the company and then usually to other shareholders next. We would include preemptive rights, which is the right to buy. If the company's offering additional equity, typically you give the existing shareholders the right to buy in that offering so that they maintain their percentage interest. You oftentimes would have voting provisions because if you have multiple rounds of financing, often each round would get the right to designate a director, so you put that in the shareholders agreement. And then you have protective provisions, and what those are really are provisions that talk about material items would require a supermajority approval to go ahead and undertake. Instead of having 50%, you'd need maybe 75 or 80%. And things like sale of the company, getting additional investments, incurring debt, selling real estate, things like that. And then you have come along and bring along rights. And what those are really provisions that allow the company to be sold as a whole. So if a supermajority of the shareholders want to sell the company, they can bring the other shareholders along, and conversely, other shareholders can require them to take them along. You go to the next slide, please. Let me contrast a little bit with operating agreements. So the operating agreement, you do have your articles of organization, but those are usually more straightforward and just have the name, purpose, some indemnification clauses in the articles. Then the operating agreement really contains the things that are normally in the bylaws and the shareholder agreements for a C corporation. So with an operating agreement, you first have to determine whether you want to be member or manager managed. And most of our clients decide to do member managed. They can still have a board of managers, but that basically allows the members to control the company. When you have a manager-managed LLC, typically you're designating a manager, a group of managers to have authority to run the company. Other things in the operating agreement would be things like the board officer's position, procedural matters, voting procedures, things like that, which are typically in the bylaws for a C corporation. And then you'd also include protective provisions, bring along rights in the operating agreement. And then the other thing you'd have in the operating agreement that would typically be in the articles for a C corporation would be the various capitalization issues. So you can have various classes of units. You can have rights and preferences. You can have differences on voting, dividends, liquidation preferences. And then with an LLC, you can also have profits interests with the company. And what that is the right to really participate in the upside of the company over a certain base level. I just want to mention S corporations, because that's another entity that people talk about. We don't see that much in the startup context, and I know Jeff's going to talk a little bit about this, but really S corporations have restrictions on who can be the shareholders and basically a limited number of shareholders and certain types of shareholders, and it doesn't work well in the startup context. I want to just touch on a couple other things that came up in the conversation ahead of time, and that is conversion. I mentioned you can convert from an LLC to a C corporation. It's easier to go in that direction than back. So you'll sometimes see LLC set up and then they're converted to C corporation later. There's really not much difference that I see as far as the annual burden, as far as filings and things like that. Both entities have to file annual reports with the state. They have to do certain things. So there's really not much difference there. And I don't see much difference as far as how universities feel about taking equity in LLCs versus C corporations. I think what's more concerning for our clients is really what's in the terms of the shareholders or operating agreement. And what we see is we want to make sure that there's oftentimes equity provisions and license agreements. Want to make sure those provisions don't conflict with what's in the final equity documents for the company, because then you have this kind of conflict of terms. So I'm just about the end of my time. I just want to summarize by saying, from a governance and structural perspective, we work well with LLCs or C corporations. That doesn't really make a big difference for our clients. It really depends on where you think the company is going to go, what type of financing they're going to have. If you're going to end up getting professional, meaning fund finance, fund investors fairly quickly, you might just start out as a C corporation. If you're unsure of that, maybe you start out with an LLC because it provides you a little more structural flexibility, and then you can convert to a C corporation later. So I tried to cover in 12 minutes what typically could be an hour and a half discussion. So I'll now turn it over to Jeff to talk about some of the tax aspects.
Marc, I have one question for you
Sure.
Before we move on to Jeff. So apologize, Jeff. So you mentioned the conversion from LLC to C Corp, which is the usual direction of how things actually will go if someone starts out as one or the other. I actually don't know C Corps that have gone to LLCs, but I'm sure there are cases where they have. But how difficult or easy is it to convert, to do that conversion? Like, what are the tasks that have to happen, and how difficult is it to convert from an LLC to a C Corp?
Yes, it's really not that difficult. You need to do a corporate resolution of your board, and depending on what your bylaws say, you might also need shareholder approval, but unlikely. And then there's really, most states, you just file a document, certificate of conversion, which changes your entity from an LLC to a corporation. Usually you can do that online in most states, and there'll be a filing fee, but the filing fee is not that extensive. And then usually as soon as it's accepted for filing, you're converted.
Okay.
Now you may also have to, work with your accountants to make sure you've got the right, tax filings done. But from a corporate structure, it's a fairly simple process.
And is it like a matter of weeks then, or?
No, it could be a matter of days. I mean, if
Great.
you had an LLC that you wanted converted, today, we could probably get it done tomorrow. So.
Great. All right. Thank you. Actually, I think we have one more. Sorry, is there limited liability in a C Corp as well? That's another question.
Yes. Both entities have basically offer a liability shield. So for C corporations and LLCs, any debts or obligations of the company remain with the company and are not personal to the individual, unless you sign a personal guarantee. That's separate. But they both provide the limited liability protection of an entity.
Okay. And just to confirm, you can convert from a C Corp to an LLC. That is a possibility as well.
It is, although I think Jeff may talk a little bit more about that. It's harder, and there's some more tax implications on that.
Let's move on to Jeff then. Thank you.
All right. Good morning, everyone, or good afternoon, depending on where you are. Next slide, please. So with tax choice of entity, there's the usual suspects in this space, and then there's the other suspects. And before I get into any of this, I just want to mention that when people talk about C corporation or S corporation, the C and the S is simply a tax designation. In either case, it's a state law corporation. So all of the rules that Marc talked about apply, regardless of whether you're a C corporation or an S corporation. It's just a tax filing or tax status that a state law corporation has. And so in this context, we typically would expect to see either a C corporation, and we'll talk a little bit about why that's a popular option, or an LLC. The other suspects that other businesses use in various circumstances, but not very common in this particular space, is an S corporation, a limited partnership. Sole proprietorship is essentially what Marc talked about before, where someone just forms a business. They don't form any type of legal entity, and they're operating on their own. And that's usually a big no-no, because then they're subject to unlimited liability for all things that business engages in. And then there's also a nuance with LLCs, that an LLC can be taxed in different ways. It can be taxed in the default way. I'll mention what that is in a moment. But it also can be an LLC, but it's taxed as a C corporation or an S corporation. And we won't have the luxury of time of going through the details of what that all means. But for purposes of these slides, we'll assume that the LLC has not filed an election to be taxed as a C or an S corporation. Next slide, please. So with the C corporation, who is taxed? Well, Marc mentioned double taxation. You may have heard of that before, and that can be a bad thing, or it might be overblown. Depends on the circumstances. But basically the way it works is the corporation itself will file a tax return, and if it generates a profit, it will pay taxes on that profit. If the corporation generates a loss, it will still file a tax return, but it will generate what's called a net operating loss that it will carry forward to future years that can be used in the future against future profits if and when the venture becomes profitable. If there is profits to be distributed, which is unusual in a startup space, usually there's a desire to keep all the money in the business and reinvest it, or there's a dearth of money and we're looking for money from investors. So it's not very common in the early stages of a business to pay out dividends. But if dividends are paid out, then that would also be subject to tax. The shareholders would be taxed on that amount. So if a corporation makes $100, it pays tax on that $100. Whatever is left over, let's assume it's $70, would be available to make a dividend to the shareholders. The shareholders themselves will be taxed on that $70 of dividend income. And so the tax hit can be significant. And when we talk in tax language, we often refer to what's called a pass-through. A C corporation is not that, and I'll explain in a minute what that means. Next slide, please. Okay, with a C corporation, there's a special benefit that is very popular in this space, and that is what's called Section 1202. And that's an Internal Revenue Code section that says that if you meet a number of requirements, then if you sell your stock in the corporation, there is the possibility for up to all of your gain on the stock sale to be excluded or not taxed. Now, there are a number of rules that have to be met. The hardest one typically is the 5-year holding period requirement, meaning the corporation has to be around for at least 5 years. The individual shareholders need to hold their particular stock for 5 years to realize this benefit. And there are some other requirements that we won't have the time to go through. Some of them are mentioned here on this slide. So this is one benefit of a C corporation that some folks really focus on, and look at is really a good exit benefit. Next slide, please. As to universities, the issue that comes up with universities can be what's called unrelated business taxable income. And essentially what that is it's a tax that can be imposed on a variety of charities or tax-exempt organizations on income that's not related to the charitable purpose of the organization. So, for example, if State U decides to set up an automobile manufacturing business, which is arguably not within the purpose of State U, then the profits from that enterprise would be subject to tax. The idea is it would be an unfair advantage for a charity or a tax-exempt organization to be able to not pay tax on business activities that are not related to its charitable purpose. So that's what unrelated business taxable income is. Now, with a C corporation, because it's not a pass-through, meaning the corporation will pay tax on all of its profits, that will stay at the corporation level. It will not be shared or filtered down to the shareholders. When monies are paid to shareholders, it's typically paid in the form of dividends, or they sell their stock in the corporation. In either of those instances, the university would not be subject to unrelated business taxable income, either on the dividend income or on this gain from the sale of the stock. Next slide, please. Okay, so in the venture capital space in particular, there is often the idea or premise that a C corporation is really the end all be all, and that's where we should start and stop the conversation. And that may be, but that's not always the case if we don't know what direction we're going to be going. As mentioned on the slide here, VC investors typically almost uniformly favor C corporations. Some private equity investors favor C Corps, but in my experience, that hasn't been 100% of the kind. Sometimes they like pass-through entities. Strategic investors, meaning investors in that particular industry or trying to grow that industry, might favor one or the other depending on their tax structure. Wealthy individual investors or angel investors, Marc mentioned on one of his slides, generally favor pass-through treatment, and we'll explain why in just a moment. Next slide, please. Okay, so in contrast to the C corporation is the LLC. And who is taxed with the LLC? Well, the LLC is not taxed on its income. What it does do in most instances is it will file a tax return and report its income and loss. But then all of that will be passed through to the owners or to the partners for tax purposes. So with an LLC, there's not a tax status for LLC. There's no such thing as an LLC category under the Internal Revenue Code. It's typically a partnership. And so when we talk about passing through profits and losses to the members for tax purposes, what we're talking about is passing through the losses and profits to the partners. The LLC itself does not pay tax on its income. And so the benefit to some investors might be, hey, I don't want all of those losses stuck inside the corporation that I can't ever use and see. I want the benefit of those losses. And so to the extent of my investment, if there are losses, I can typically take those as an individual investor in an LLC structure. And that's one reason why LLCs can be favored. Next slide, please. Okay, as to the tax classification, as I mentioned, for tax purposes, the LLC equivalent is a partnership. Well, sometimes you can have a one-member LLC, and you can't have a partnership, which is two or more people, with a one-member LLC. And so with a one-member LLC, what it is for tax purposes is it's what's called disregarded. And that's literally the case from the taxing authorities. The LLC does not exist. So from the taxing side of things, the taxing authorities will look to the owner of the LLC, and that owner would be taxed on the profits and losses of the LLC. With a multi-member LLC, it would be a partnership. One detriment to an LLC is Section 1202 stock is not available. And as I mentioned earlier, there are special considerations with LLCs that go way beyond the time that we have here to discuss LLCs in various different tax categories. But one takeaway from this when we're dealing with LLCs that behooves everyone is to ask the question, what is the tax classification of the LLC? It might be the default status of a partnership in a multi-member status situation, but sometimes we can run into an LLC that's filed an S election, and that could lead to all kinds of traps for the unwary if people aren't aware. Next slide, please. Okay, the issues and benefits from the university standpoint is this unrelated business taxable income. And because an LLC is a pass-through, it just reports its income, and each member is responsible for its share of profits and losses. And so the detriment to a university investing in an LLC can be that it could be subject to this unrelated business taxable income on its share of the income if the LLC's activities are not related or consistent with the charitable purpose of the university. Now, there are workarounds. I mentioned here on this slide, there is potential workaround to dealing with this where a university really wants to invest in a particular LLC. Maybe it sets up its own subsidiary corporation to hold the investment. That's what's referred to sometimes as a blocker corporation. Other universities, they don't care about UBTI. They may have operating losses from other ventures that they aggregate, and it's a net no big deal. And others just don't really care. So it's a mixed bag on that front. Next slide, please. Okay, an S corporation, touch real briefly on this because we just simply do not see an S corporation in this space. And again, an S corporation is a state law corporation. It's just got a special tax category of being a pass-through, similar to an LLC, but different. There are problems with S corps as to who can be owners. If the ownership requirements are not met, the S corp, thinking it's a pass-through, could default into C Corp status. And in some instances, that's a bad result because the pass-through treatment isn't there. The corporation itself would have to pay tax on its income. Many universities can own stock in an S corporation. There's a special category under the tax rules that allow for that. But the default is that a university owning stock in an S corp would have UBTI. There's no question about that. Next slide, please. Okay, so there was a number of questions about conversions, and the short answer is, like Marc said, it's really easy to file documents with the state to convert from an LLC to a corporation. And in most instances, that can be done tax-free. And so if people are uncertain as to what status they need to set themselves up as because they frankly don't know what the future holds, it may not be a VC investment opportunity. It may just be wealthy individuals. Who knows? We would typically recommend if someone truly does not know and they're really uncertain, we would probably recommend they set themselves up as an LLC. And then down the road, they can convert to a C corporation with one gotcha that can be out there. And that is if there is significant debt that the LLC holds, then there could be a tax hit upon the conversion. There's not a right answer as to when someone should convert. If someone is certain that in the near future they're going to be entertaining VC investment, then probably making the conversion now makes sense. If there is an opportunity to do an exit through an IPO or through some kind of strategic buyer that wants to buy the company, not with cash, but through public company stock, then it would be certainly behoove someone to consider making the conversion at that time. And in the next few slides, we won't really have time to go through them. We talk about different exit consequences. And one of the exit consequences is perhaps doing a stock for stock exchange, where that only works if there's the target or the entity is a corporation, and it essentially exchanges its stock for stock in the buyer. And in many instances, that can be done and structured in a tax-deferred manner. Next slide. We'll quickly go through the next two slides. So again, the exiting the venture, you can do a sale. There's two types of sale. You can do an equity sale, meaning you sell the equity or the stock. In either structure, that would be a single level of tax, just the stock sale or equity sale in the LLC. And if it's a C Corp, there's a possible benefit of Section 1202. Next slide, please. An asset sale, the one detriment with the C Corp, again, is this double tax thing. And what it amounts to is if a buyer wants to buy assets, which some strategic buyers want to do, from a liability standpoint, they want to pick and choose what assets and what liabilities they inherit, then they might want to buy assets. And if the corporation sells its assets, it's going to pay tax on the gain on the sale. And then it needs to get the money to the owners. Well, that'll again be taxed to the shareholders. And so that's one downside to a C Corp in an exit with an asset sale. Next slide, please. And as I mentioned, the tax-free exchange concept really only works for corporations, C Corps, and it really only comes up when we have a public company buyer where there's publicly traded stock. We sometimes see it in other privately held instances, but that's not very common. An LLC cannot do a tax-free exchange in this context. There are other ways to structure potentially a tax-free exit, but not with a stock-for-stock exchange. I think that's my time, Kirsten.
It is. And I'm going to take one more minute to ask a couple questions, and we'll move on to Marc because we're getting a lot of questions about the investor perspective on this. So one is for the Section 1202 stock, would a surgical tools based company qualify for this? You mentioned, I think, that certain life science and engineering companies would not qualify.
Yeah, Section 1202 was written a number of years ago, and it really wasn't popular because the tax benefit just wasn't there, and I won't get into the details. There are certain categories of businesses, fields of health is the one I think we're focused on here, that don't qualify. And there isn't a lot of guidance on what that means, but for the most part, what it typically means is physicians, doctors, psychologists, people who provide services. They basically provide their time in exchange for services. If we're dealing with an industry that's providing medical tools or developing things that are ancillary to that, but it's the medical or health space, then for most part, that would qualify.
Okay, great. And then what are tax implications of investments into your company when you have a percentage stake in equity as a founder for LLCs versus C Corps? What are their tax implications of that if you're making those investments, as well as having a stake as equity as a founder?
Yeah, so if you're the founder, you would take ownership. You would typically be diluted by investors coming in. And the challenge that founders have is not giving away too much equity too soon. Because if you give away too much equity, then the early investors will be the kingmakers, and then the later investors there won't be enough for the founder to retain ownership, and for the investors to come in and take a minority stake. Typically, the investment by third parties will not negatively impact the founder. Sometimes if we need to make a conversion from an LLC to a corporation, it changes the founder's tax status, but it doesn't necessarily result in an immediate tax hit.
And then last question, what is your position on B Corps?
I don't do a lot of work in the benefit corp space. That's a social welfare type of activity that folks will set up a corporation with the intention of targeting a particular social welfare or benefit, and there is some benefit to that. Certain investors are attracted to that, but typically that doesn't change anything that I've discussed. I believe you can have a benefit type corp, and so it'd be C Corp rules would apply. Or in some states, I believe they would allow for a benefit type LLC, a C3 LLC type thing, and that would be a similar analysis typically.
Great, thank you so much, Jeff. All right, we'll move on to Marc Singer.
Thanks. Hi, everybody. Marc Singer from OUP, and we can go to the next slide. So I'm just going to talk through the investor perspective on, in particular, LLCs and the choice between using LLCs or a C corporation. So first, as Jeff mentioned, there is a very strong orientation in the venture community towards avoiding investing in LLCs. So some of that is just because of the history of it. So if you talk to a lot of VCs and push them as to why they won't invest in LLCs, the depth of understanding from the VC side is often not that deep. They've just been told they shouldn't do it, and so they don't want to do it. We at OUP have in fact invested in LLCs, so we've had to contemplate this at a deeper level. But let me first kind of talk about why there is a preference to avoid LLCs. The first is because of the nature of our investors and our funds. So many of our investors are in fact tax exempt investors. They could be foundation endowments. They could be universities or other investors that are tax exempt. So as Jeff and Marc mentioned earlier, they don't want UBTI. And if we invest in LLCs, that creates the potential for pass-through income for them that they do not want to have. And so at the extreme, some of our investors prevent us, like make us sign a letter saying we won't create any UBTI for them. And so our investors do not want the pass-through income. At OUP, we have the further kind of benefit and challenge that our universities who are our partners share in the carried interest of our fund. So they are special limited partners. They also generally prefer not to have UBTI also. So if we're ever to invest in an LLC, we have to make sure that we are not creating pass-through income for our tax-exempt investors. So that's kind of the main concern. Beyond that, there's also just less familiarity in the venture community with LLC documentation. And so on the C Corporation side, there are very standard documents that most venture capital funds use for their investments, anchored around the NVCA template documents. NVCA is the National Venture Capital Association. So they have standard documents that most of the deals we do are built off those standard documents. There isn't the same type of standardization around LLC documentation. So we're less familiar with them, we have less comfort, and it takes more work. And in most cases, if you're a startup raising capital, what you don't want to do is create work and complexity for your investors, because that can slow deals down. It can also be a reason an investor would say no. And so it is more work for us when we consider an LLC investment. And then also there are some exit implications that both Jeff and Marc referred to earlier, that if we did invest in an LLC and it was going to go public, you've got to convert later. You can do it, but it can add some complication. You also can't do stock for stock mergers. Sometimes our companies do stock for stock mergers. And if you're in an LLC and you get stock and you're taxed, you don't have the cash to pay the tax. So it is kind of a true complexity. That being said, we do look at deals again that are LLCs, and as I mentioned, we do invest in them from time to time. If there is an LLC that comes to us and raises capital, our preference is to convert that to a C corporation at the time of investment. And as was mentioned earlier, that's usually a pretty straightforward process. Sometimes there is a reason that the company wants to remain an LLC, and I'll talk about that a little bit. And there we can use a blocker where we would invest in a C corporation, and where the only asset of the C corporation is the investment, is the equity in the LLC or the member interest in the LLC. So we do have the ability to create a blocker to allow us to invest in an LLC. It just, again, creates a little bit of cost, a little bit of complexity on our team. It makes Beth's life a little bit harder, and she can talk about that a little bit. So we prefer to avoid it, but venture firms can invest in LLCs using blocker corporations. And then there is a last point. Jeff mentioned that if you have an LLC and you sell an asset, there is not double taxation. Like there's a tax benefit to selling assets out of an LLC because that you're not taxed at the LLC level, you're only taxed at the member level. Whereas if you sell an asset in a C corporation, you have the potential for double taxation. So there is a role for LLCs increasingly in some life science companies that are developing multiple assets where they expect it's less likely they'll sell the company in its entirety, but they might sell out individual assets, individual molecules, for example. And so sometimes we've seen life science companies intentionally use LLCs, not for the flow through profit for their members, but to actually make asset sales easier. And so they can go have multiple asset sales, and where the tax benefit of that, there's no double taxation attached to it. So that's where we've seen a role for LLCs is in life science companies developing multiple assets. Outside of that, most of the time when you're selling your assets, if it's not selling a great molecule to a pharma company, most of the time when you're selling assets, it's because it's a troubled company. And so in most cases, outside of that one example I mentioned, asset sales are kind of bad outcome sales where there's not tax to begin with. And so having that tax benefit only really applies to specific biotech related investment situations. So those are kind of some of the things that we think about on the investor side. Kirsten, are there questions that I did not hit?
No, actually, and you actually hit the one question that came in with your last point. Although I'm going to ask the same question to Marc Ehrmann later. So I think we can move on to Beth on accounting considerations.
I know this is the most anticipated part of any panel, is talking about accounting, but I'll be brief. You can go to the next slide, Katie, thanks. So I just wanted to talk about, from an accounting perspective, whether it's an LLC or a C Corp, if you're accounting for, revenue, expenses, assets, liabilities, there's not much difference, in actually keeping the books for the different entities. Where the differences come in, and it can be a little bit more complex for the LLC, is on the ownership side. So, LLCs, they don't issue shares of stock like in the traditional sense. The ownership for each member is calculated in reference to each person's capital account. So, if you have 4 partners and they each own 25% of the business and the business earns $100, you have to record $25 in each person's account. And then if you would go and then have an $80 expense, you have to record, $20 of expense in each person's account. And you have to be tracking that, from inception through the life of the fund and allocating each partner's revenue and expense items to their accounts. And that concept, doesn't exist for C Corps. You own a share to represent your ownership. So you don't have to deal with any of the capital account maintenance, which can be time consuming and expensive for the entity. Another point is, I know we're talking about like starting entities, starting an LLC or C Corp, but you also have to think about down the road, what about when owners leave the entity and depart the LLC or the C Corp? So, with a C Corp, it's pretty well defined, if you're a manager and or an owner of the company, whereas with an LLC, like that's a little bit more inherently commingled. So if someone decides down the road that they're going to leave the entity, you need to determine if that's going to be a clean break and they're going to be totally out of the entity, and in that case, all the other members have to buy out their ownership interests. Or, you can have that person retain their ownership, but they do still, they would still leave like as a managing member. And there's no right or wrong way to handle it. It's really how the entity prefers it. But where the issue comes in is there's just negotiation around that. And you can kind of set up your documents that those terms exist up front. So there's less negotiation on the back end. But either way, you kind of have to figure it out. It's a little bit muddier, with an LLC with someone leaving versus with a C Corp. And then also just thinking about retention of earnings. We talked about this a little bit in the beginning. And, with startups, lots of times, you're not quite in the revenue earning phase yet. But when you do hit that point, you have to think about with an LLC, the earnings, as we've mentioned multiple times, they pass through to the members and the members are taxed on those earnings. And Marc brought it up, this idea of like phantom income, where you can have income allocated to you, but if no distribution is made, you're still taxed on those earnings, but you might not have any cash to cover those liabilities. So lots of times for LLCs, for their owners, they set up in the documents that we will make sure we distribute a minimum amount of money to you every year to make sure that we cover your tax liabilities. And so money that's being earned by the business then needs to go out to those owners to cover their tax liabilities. Whereas in a C Corp, you don't have that. And the board can decide, do we want to do a dividend? Do we want to keep all the money and reinvest all the money, back into the business? And how do we want to handle that? So there can be a little bit more flexibility with the C Corp in reference to what you're doing with your accumulated earnings. And then just one other point. I know we're getting towards the end of our time here, so I'll be brief. But the one plus with LLCs, and I think there's a question that alluded to this. There are fewer regulations and there can be more flexibility in the documents that you're drafting than there are with the C Corp, and that can translate to less paperwork and less overhead. Whereas C Corps have stricter rules and regulations. You have to have so many shareholder and directors meetings. You have to give proper notice for those meetings. You have to keep minutes. There's a lot more regulation around maintaining your good standing with a C Corp, whereas LLCs can usually be managed a little bit more informally. So that's just a little bit from the accounting / compliance in-house perspective.
Thanks, Beth. And is there, I think you kind of talked about this at the beginning, but as far as your like yearly burden, as far as accounting goes, how, it sounds like it depends kind of on, how many, partners there are in the LLC, et cetera. But is there much of a difference between the accounting burden each year between LLCs and C Corps?
It's so hard now. My life is so, no, I'm just kidding. It can be, it really can be harder. Kirsten alluded to it. If you have a lot of members, it can get expensive. If you have a single member LLC, not so hard. It's all going to one person. But if you have a multi-member LLC, you could have 4 partners or you could have 200 partners. And so really it kind of depends on the structure, on how hard the burden is going forward. So it just varies, really. To be honest, I know it's not the best answer. You don't want to hear it varies and it depends, but it really does.
It depends.
Unfortunately. But once you get it set up, yeah, exactly. But once you get it set up, you can get it into a recurring framework. So that should take the burden off in the later years.
Okay, great. Thank you so much, Beth. We're going to go to our Q&A period. I know we only have about 8 minutes left. If we need to go long, we will, but we do have a few questions now. So I'm actually going to go to a question first that Marc, you answered at the end of your slide, but Marc Ehrmann, I'd like to ask you as well. So what are the business reasons, non-tax, for creating an LLC versus C Corp? So when you see someone come to you, say, and you're advising them about whether to set up an LLC versus C Corp, what are usually the business reasons that you're providing to them?
I think it's really just the upfront flexibility that it does provide you, because there's a little bit more, as I mentioned, flexibility within the documents, but also, as Marc mentioned, if you think you might have, let's say the company's going to have 3 main lines of businesses, and you think that you might have, separate investors for each, you can more easily spin one business out to allow for the investors in that business, and maybe the second line of business gets different investors. So it may not end up that way, and if it doesn't end up that way, their mechanism is to convert or to create a blocker like we talked about. But you have a little bit, I think, less flexibility up front if you start as a C corporation to do some of that structural stuff down the road. So I guess maybe the flexibility is the main reason why you'd start out as an LLC, not knowing where the business is going to go.
Okay. Thanks. Jeff, next question to you. For LLCs that elect to be taxed as a C corporation, is the equity structure also treated as a C Corp structure? The LLC now has shares/stock options as opposed to membership units, profit interest units, or how does this work?
Yeah, this becomes challenging because it's schizophrenic. You have the tax rules are completely different than the normal, what I'll call normal state law rules. And so the tax rules are, you're a corporation. You have stock, you can do stock options. All of the C Corp rules apply. And you have to translate that into an LLC operating agreement in a way that makes sense. And so ways that we commonly would see that work is, instead of having membership interest reflected as a percentage of ownership, we might say we have units of membership. And so each unit is the rough equivalent of a share of stock. And it's that kind of thing that there needs to be customization to the operating agreement. You can't just take any old operating agreement form that's got partnership tax provisions in it that Beth alluded to, because those don't apply. You have to take those things out, and you have to do your best to try to put in provisions that look like corporate rules for tax purposes. And this all gets to the issue that Marc alluded to, Marc Singer, that in this kind of situation, an investor is going to look at this and they're going to have to spend a fair amount of time trying to understand, what did you do? What do you have? And am I supposed to be investing in that? No, let's just convert to a corporation.
Thanks. We have another question that goes back to the UBTI issue again, and the universities receiving shares in an LLC as part of their license agreement. Marc, and I know, Marc Ehrmann, I know you talked about this a bit, but maybe you could run through it again. And let me just read the specific question. Can you talk about the implications for a university if it receives a membership share in an LLC startup as part of a license agreement? Is there a way to avoid UBTI? And I think we talked about those block or C corporations. Could you go into that again?
Yeah, well, maybe I should defer to Jeff on the specific structural thing, but it is I'll just talk about the governance thing for a second. It is very common to have a license agreement with an equity agreement type of clause. And typically there's a grant of equity at the time of the license in exchange for a certain percentage of the company. And then oftentimes there's what I call anti-dilution provisions up to a certain amount of money. So a certain value for the company. So I'll defer to Jeff as to how that works from a UBTI perspective. But you want to make sure that you're kind of doing the corporate analysis and the tax analysis in tandem.
Yeah, from a UBTI standpoint, it's you're receiving an equity position in a pass-through entity. Presumably, this LLC is a pass-through. And if so, you could have UBTI, and it's an analysis by the university as to, are we okay with that, or do we need to do things to work around that? Do we go to the extreme and ask the company to convert? Do we have the leverage to even ask that question? Or do we do something in between? Maybe we hold our investments like this through a corporation, a subsidiary corporation. Several of us have mentioned this blocker corporation to hold the equity investment might be an option. But some universities are okay with UBTI. Right. It just really depends on their particular appetite and circumstance.
Yeah, and that's been our experience as well with Marc. I see you nodding too. You want to mention this?
I was probably going to mention the same thing as you, that we've seen over time a change a little bit in university orientation towards UBTI. When we started OUP, our partner universities were extremely sensitive to making sure we never created UBTI for them at all. And over time, we've just seen that soften a little bit because they wind up with LLC interests and other kind of sources of UBTI. So now they're looking to manage it down as opposed to prevent it in all cases. So we've definitely seen a change there.
All right, last question from our audience, and this is for both OUP and Quarles, and maybe Marc Singer, I'll ask it of you first. What % of LLCs that you work with or serve or invest in do not have a board of directors? Does OUP always require one before investing? And if yes, how many board members minimum in an LLC?
Yeah, so we haven't invested in very many LLCs, but I can confidently say that 100% of the LLCs we've invested in have a board of directors because 100% of the companies we've invested in have a board of directors, regardless of the structure. So it's really important for us that the founders that we are investing behind also kind of seek out expert knowledge and industry knowledge. And so we always want to make sure they are surrounded by a board of directors that can provide them with what they need. It doesn't have to be us, but it does have to be, we do think that there is a role in startup creation for a board of directors helping provide guidance to founding teams.
Great. And Marc Ehrmann, do you want to also just provide your perspective?
Sure. Yeah, almost all of our clients have boards of directors if they're LLCs, and I think maybe 100% do once they get outside investors for the reasons that Marc Singer mentioned. I mean, it just makes the management easier. And you can oftentimes put in the operating agreement, maybe restrictions on what the board of managers can decide without going back to the members. But if you don't have a board of managers, then you typically would have to have member meetings all the time. And if you have multiple members, it just gets very cumbersome and difficult to manage. And a lot of those members typically aren't directly involved in the company and they're just kind of passive investors. So I would say 100% of our clients, once they get outside investors from funds or VCs, have boards of managers.
All right. I'm going to ask one last question and squeeze it in there, even though we're at the top of the hour. When is a good time to turn an LLC into a C Corp? Is it ever too late or too complicated to do so? And I guess, Marc Ehrmann, this would go to you, and maybe if anyone else wants to chime in too from their perspectives, tax, accounting, or investor.
Well, I'll start out from a corporate perspective. I think, again, if you're getting outside investors that don't want the pass-through income, you're either going to have to convert or create a blocker. Certainly with certain strategic exits, you're going to need to do the C corporation. I don't know that there's, from a governance structural perspective, you can kind of do it at any time, but you really have to analyze. That's where I turn to Jeff from a tax perspective. You may have created certain obligations that make it difficult to do from a tax perspective once you pass a certain point.
Yeah, from a tax perspective, there's not a right or wrong answer. It depends. Kind of going back to Beth's, it really depends on the circumstances. Kind of analysis. There can be instances where it's too late, or it makes it tax challenging to convert if there's a lot of debt. I alluded to a tax trap that's out there. I won't get into the specifics, but if there's a lot of debt, trying to make the conversion can be tax tricky. Or if someone is trying to do a stock for stock exchange that both I and Marc Singer both alluded to, you need to make the conversion soon or earlier in the game than right at the last moment, because the tax rules may say, yeah, that was nice. We like the idea that you made that change from LLC to corporation, but we're going to disregard that from a tax standpoint because it happened right before the stock for stock tax-free exchange. And so we're going to treat it as a taxable exchange. And so that could be another instance where you wait too late to make the conversion.
And I might just add on with a quick story, maybe to end the session. 30 years ago, the very first venture firm I was at, we had invested in a company which was called Boston Beer, which many of you know as Samuel Adams Beer. It was one of the early craft brewers. And the firm I was at had invested in Boston Beer as an LLC, had used a blocker corporation, and it kind of lived a lot of the things we discussed, where Boston Beer started generating a profit really early in its life. It was really successful, and it actually started making tax distributions back to all of its members because it was generating a profit but was not paying out distributions. And then it went public, and then it wanted to go public. And on the conversion, so to go public, it had to convert from an LLC to a C Corp. And that conversion restarted our holding period clock for our long-term capital gains. And so that actually created a giant complexity and a problem for us that we had to then hold the public stock for much longer than we otherwise would have because the clock restarted and to get long-term capital gains treatment. The rules were different then than they are now, so I don't know if it would apply today, but just shows some of the complexity of waiting to convert later.
That's a great story, Marc. Well, I want to thank you all so much for being our panelists today on this topic of LLCs versus C corporations as startup vehicles, particularly academic institutions, since that's our main audience here. You can see the contact information for all of our speakers today here, so please do reach out if you have any further questions. We did try to get to all the questions that were provided to us beforehand or that were asked today, but feel free to reach out to them if you do have any further questions for them. And we'd like to thank all of you for being here as well. You will be sent a survey afterwards. Please do answer it. Let us know how we did. The survey is also in the chat right now. If you can answer it for us, we do appreciate it. We do obviously respond to the comments that are provided, as well as end up focusing our future webinars based on ideas and topics that are brought up from these surveys. It's a very short survey, 5 questions long. I want to thank very much again all of you for joining today, and again to our panelists, Marc, Beth, and Jeff for being here today and providing all this valuable information. And I hope everyone has a terrific day. Thank you all.